All right, welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker C, Citigroup, uh, one of the largest investment and consumer banks in the United States and international. Pretty well-known company. I assume basically needs no real introduction, but very interested in getting into this company. Kind of matches up with the last valuation that I did in JP Morgan Chase, and also my next planned valuation that I have, which is for ticker GS, Goldman Sachs. Kind of taking a brief little look at three of the largest consumer and investment banks. Not all of them entirely apples to apples exactly, having some of them having slightly more investment characteristics versus consumer characteristics, and some having different mixes internationally. But either way, those are three large banks that I kind of wanted to take a quick look at. And today we're taking a look at Citigroup. Here, taking a look at my watch list of other companies that we have done valuations for on the channel. I am noticing a few other things. One of the other companies that I've recently did a valuation on, which I've noticed we've had quite a lot of views on the valuation itself, and I'm pretty sure we got a decent amount of new subscribers from said valuation. So if you came from watching my Zim integrated shipping valuation, hi, welcome to the channel. But I noticed that it has dropped a little bit more ever since my valuation. So I mean, I kind of passed on it due to having large risks at hand at the current price it was at when I made the valuation. But you know, at some point or another, if it drops to a low enough point, I'll have to consider it even further. I was trying to think about that a little bit before the stream started today. Beyond that, I made purchases this week, more in Interfor, a little bit more in Meta, a little bit more in Smith & Wesson, and also a little bit more in Turtle Beach. Some more purchases for my own portfolio. Not to mention, I've been shuffling out of some less confident positions, trying to concentrate my portfolio into a little bit more of the more confident positions, and looking to discard less confident positions overall. With the three banks that I was saying that I'm working on currently, also have other planned valuations on the forefront. We got the annual report from Samphire Resources, ticker SFRRF, which is also one of our personal holdings. So I'm working behind the scenes on my valuation for that. So once I get through with the three banks that I'm working on, that'll probably be the next valuation I do after that. And then I have a few others that are on the horizon that I've been kind of looking to pay attention to. Micron has its new annual report in this kind of time frame that I'm looking to take a look at, as well as a couple others. So we'll get into some economic information before we get into the valuation. Some stuff that was released today included consumer confidence reports of at least partial information, as well as the S&P Case-Shiller index for housing, which was very interesting information to take a look at. Move over to the Trading Economics economic calendar, which I find to be a very useful calendar of a lot of economic data to look at. They actually have some of the information here. You can take a look at it compared to the consensus information. The consensus for the Case-Shiller was that it would go to a year-over-year change of 19.5%, based off of the changeover in the month-over-month that it would have in the most recent month. But it actually came in at 18.6, so it actually came in a little bit cooler than it was expected, relatively, partially just due to the most recent month period basically being flat. So housing coming in a little bit cooler than expected, has the markets moving in some regards. Not to mention also we have a larger amount of job openings coming in with the JOLTS report than was expected, about a little over 11 million versus about 10.5 million that was expected there. So interesting details coming out economically, which has put the market a little bit of a downward move, as well as Fed Head Williams gave a speech basically indicating that they would be keeping rates higher for longer. So yeah, interesting information there. Also, I did notice the oil prices were down today, and that also looks to be on the back of a larger growth in the oil stock relative to the decline in the oil stock that was expected. So that means there's higher supplies, and so therefore prices have fallen. So some interesting economic data coming out right here. I also wanted to take a small brief detour to take a look at an interesting projection that I put together as far as like where I think inflation can go in the very near term. I definitely think that we haven't seen peak inflation currently. That's my personal opinion. But I wanted to show an interesting methodology of getting an idea of like where the next inflation report that we're going to get within a couple weeks could possibly come out to be. So right here on this spreadsheet, this information right here is the commodity price index. I just wanted to get an idea, so getting based off of where commodity prices have gone, where do we think inflation could possibly go in the near term? So I have the commodity price index, the GSG index going back to 2006 all the way up through the most recent time frame right here on this table. And then over here I have inflation data based off of the CPI going back for the same time frame. And then I have them laid up next to each other. And then in these two columns, I have the month over month change for each of those. And you can see that if we actually take a look at the month over month change between the commodity price index and the consumer price index, you can see that there is in fact a 67% correlation between the two. And there's also an R squared of about 45%, which means that the changeover in the commodity price explains about 45% of the change in the consumer price index, which sort of makes sense when we also hear numbers like services having a larger impact than commodities on the consumer price index. So the idea that it would be less than half kind of makes sense, but still having a very strong correlation. So using this information, this is also based off of, it's worth noting that when I'm taking a look at the changeover of the commodity price, what I do is I get my best approximation of the monthly average by taking a look at the difference between the high and low on each individual day, the average between the two, and then taking an average of that over the course of an entire month, and then I back set it 1 month so that you can get an idea of what it was for the commodity prices when it moves into the CPI next. And what that does is it leaves me 30 days left over at the bottom of this chart right here, which is basically the most recent month of August that is not essentially accounted for in that correlation. And then if I take the average of those days of the most recent month, I come up with where the commodity price average is currently and where that current average is compared to the last most recent month, which we have right here. I get a downward move of 30 basis points in the commodity price index. So basically over the last month, on average, there's been about a 30 basis point downward move in commodity prices. If I plug that into a linear forecasting method in Excel, I can then essentially find out what would be the likely changeover in the CPI based off of that move in the GSG, which comes out to be a positive move of 19 basis points for the CPI. And so essentially that's what I'm saying, is that I would say that if you were going strictly off of projecting off of commodity prices and where commodity prices have been over the last month, and we're basically at the end of the month right now, which is why I feel comfortable making this projection now, then you would expect the CPI to actually move up month over month about 19 basis points in the next report that we get. Again, that's just based off of commodity prices, and commodity prices only explain 45% of the changeover in the CPI. So that means that based off of that, that's 45% of the changeover we would expect. I expect personally that it will be higher than 19 basis points. And my argument for that is that, well, again, the service sector being the other 55% of the CPI changeover has had a little bit more of a sustained upward movement in the most recent period. It did actually move up in the most recent month, even though it was a much slower rate relative to the movements that we had in the commodity prices. And then also, if you look at component parts of it, that being the rents, you can see that the rents themselves have not been moving up at the same rate that the housing prices have moved up, which goes in line with the other chart we were looking at, for example, with the housing prices still being up 18% over the last year, and yet rents are only up 5.5, close to 6%. And so what that means to me is that there has to be a larger move in the rent inflation, and that's not accounted for in the commodity price basement. So essentially what I'm saying is that I see a base floor of 19 basis points being a month over month change in the next CPI report, but I could easily see it being much higher than that. So just kind of an interesting diversion into a little inflation projection that I'm making. We won't get that information, like I said, for another 2 weeks, but hey, sometimes you got to make predictions ahead of when people are willing to make them. So that's my inflation prediction for that. So we will actually get into the valuation I have for Citigroup. Coming over to the page, you can take a look at some of the basic company info. It was first founded in 1812, one of the oldest banking institutions in the United States. Incorporation on the New York Stock Exchange and operating only in the United States dollar. Their websites I have listed here. The current CEO is Jane Fraser. She was elected to be CEO in the early start of 2021. However, she's actually been a part of Citigroup in one form or another. She's been heads of various branches throughout the years since 2004, 2004. Being it is a very large diversified bank, the part of the money center banking industry. Their customers and suppliers being part of the banking industry is not super relevant, but they do have roughly the same set of competitors that we discussed when we did our last valuation with JP Morgan. being basically all the other major consumer banks and also some of the larger investment banking institutions in the United States: Wells Fargo, Bank of America, JPM, Goldman Sachs, Morgan Stanley. There's many others we could possibly list. Their next expected report is going to be mid-October, based off of when their last report is, but that is a little bit of an estimation. In their presentations, they do give some guidance information, but not overly specific. Low single-digit growth is what is expected, ex divestitures, which we'll get into because that kind of has an effect on it, where they're saying low single-digit growth, but if we actually take the divestitures into account, then logically speaking, we should see actually an expected decline in revenue growth, but we'll get into that when we look at the presentation ever so briefly. And then other guidance, they also gave a 5 to 6% increase in expenses guidance, also ex divestiture, so that's something that has to be taken into account there. And then we're expecting to have a 7 to 8% divestiture. They've listed that as part of the expense part and not as part of the revenue part, so we would see that basically being as a part of an increase in expense, and then just thinking of it as flat in terms of revenue. So low single-digit growth in revenue, but then possibly a larger combined double-digit expense, including divestitures. Maybe if you try to think about those things together, just kind of a weird ballparking back of the napkin way of estimating it. But we do also have estimates from the analysts coming from Yahoo. 75 billion or so is according to 18 analysts, and with a 76 billion or so according to 18 analysts for next year. $7.20 for the adjusted EPS according to 20 analysts this year, and then $6.92 according to 22 analysts for next year. The trailing dividend is $2.04, and it appears that for the forward dividend that it's the same, $2.04, and that comes to a 4.16% dividend yield. And I did not find information on buyback authorization, or I'm pretty sure I remembered to check for that one. I didn't find it, unless I'm confusing it with another one. It's possible that I'm forgetting something there, but I'm pretty sure that there was no buyback authorized for them. Very small amounts of insider holdings. That's somewhat to be expected with their size and scale, but 0.21% insiders held. Very tiny movements as far as insider increasing in holdings in the most recent 6 months, basically negligible, but technically positive. And then the majority of their float is held by institutions, which also makes sense given their size and scale, coming in at 73 to 88%, 73.88%. Percent short of their outstanding shares is a little under 2%, and considering their float and their outstanding is basically the same, then there is no real difference with the short float. The short ratio coming in at 1.72 days, meaning that based off of the current amount of volume, short sellers can cover their shorts in about 1.72 days of normal trading. 3 months average volume coming in 19.7 million shares, and then in last 10 days it's averaged 13.7 million, so it's been a little bit light on the volumes in the most recent period comparative to the last quarter or so. Before we get into the segmentation of the business, I was going to come over to their earnings presentation and cover a few specific details, just kind of covering some of the specific plans and how they're operating their business. Not a whole lot of the specific financial information, but like specifically wanted to cover these things right here: progress against priorities in Q2. They've been working to kind of reorganize a lot of their business, specifically focusing on the strategic execution that they have right here, executing on certain growth aspects of their business in here, but also working on divesting a large section of their business. 14 divestitures, completed sale of Australia consumer business, in the process of closing 8 other consumer business transactions, and the Korea wind down as well. Coming over to the 10K, which was from 2 quarters before that, you can see that this was the way that the operating segments had been set up prior to this year, with the institutional clients group and the global consumer banking group right here, with the mixing of geographies depending on the business format, and then also the corporate section with the different regions that they operate listed down here below. But then getting into where the reorganization that they're going through with the strategic refresh, I'll actually just read it. As part of its strategic refresh, Citi is making management reports changes to in line with its vision and strategy to include assist Citi in decisions about resources and capital allocation to assess business performance. In the first quarter of 2022, Citi will revise its financial reporting structure to align business reporting changes to enable investors and others to better understand Citi's businesses. It is a very complicated financial institution, so somewhat good luck to them with that, but that is the way it is. First, Citi is creating a personal banking and wealth management segment. This will consist of 2 distinct reporting units: U.S. personal banking business and global wealth management business, which will include the private bank. Second, with respect to its institutional clients group, Citi will begin reporting under 3 reporting units: services, banking, and markets. Services will include treasury and trade solutions and security services, reflecting the importance of business of Citi's future. Finally, Citi is creating legacy franchises, a segment that will consist of all businesses Citi intends to exit, see below, including its remaining legacy holding assets, which really gets into the divestitures that they're talking about. So they're working on essentially getting rid of large sections of their business, including Asia consumer, Mexico consumer, small business and middle market banking, and then other legacy assets. So they are working pretty hard on divesting those parts of their business, which that relates into the guidance that I was talking about. Where if we come down here a little further, where they talk about the guidance in more specific detail, where is it here? Yeah, so they have the low single digit growth expected, but that's not including the effects of divestiture impacts. So low single digit growth, but not including the fact that they're going to be lowering their revenues by divesting their businesses, which means I would expect them to be flat, if not low single digit down in total revenues. And then also they basically kind of give the same note here, where it's going to be fiscal 2022 5 to 6% growth in expenses, x 2022 divestiture impacts, but then fiscal 2022 7 to 8%. X 2021 and 2022 divestiture impacts. So I would expect them to possibly have into double digits as far as once you include the divestiture impacts. So yeah, just kind of like taking their guidance into account and in their overall segmentation. We can also come over to the main valuation and kind of start taking a look at the segmentation as how it operates into the or as how that plays into the discount rate that I've made for the company. Oh, God damn it. Coming down here, since they are part of the money center banking industry, I give them an unlevered beta of 0.88, and that means they have sales of capital for the industry of 0.27. That's 27 cents in revenue that they get for each dollar of capital they have invested in the business, which is what you typically would expect for large financial institutions. A huge capital base, being that they're a financial institution, and then their margins in the most recent year period has actually been basically about zero. That's a little bit more of a fluke of the individual year. Typically speaking, when you have a company with really low sales capital ratio, you expect relatively higher margins, at least in the double digits or so. Like I said, this is the most recent year average, so we can kind of just ignore that, at least for the time being. So disaggregating their revenues and their assets based off of where they do business. As we discussed, they have large sections of their business being done in the Europe, Middle East, and Africa geography, as well as Latin America and Asia geographies. Only 38% of it actually coming out of the US specifically. That means I end up levering up their equity risk premium after adjusting it for the current portion of the year. An ERP ends up being 7.11%. And then the unlevered beta of 0.88, since they're also a financial institution that does deposits, they end up having a pretty huge debt to equity ratio, which is not uncommon for these types of financial institutions. And with the way that I do my betas, that means I use the leverage that they have to use the unlevered beta to turn it into a levered beta. So they go from 0.88 to a beta of 2.44 after we adjust for the really huge amounts of debt that they have relative to the equity in their business. Because after counting all of their debt, including their preferred debt and also their lease liabilities, I see $276 billion in debt at a weighted average maturity of 27 years and interest rate of 2.64%. So pretty good interest rate, really good interest rate, which is also not uncommon for financial institutions, and a really good maturity. 27 years, that's a ton of time to be working with the money, and at that kind of interest rate, that's really great. But then taking a look at their market cap, they're less than $100 billion in market cap. So yeah, huge debt to equity ratio. Okay. Hey, how's it going? Yeah, I'm definitely excited to show the differences between the two. It was taking a look at both of them, and then also counting Goldman Sachs in there, because like I said, that's kind of the third one that I'm doing kind of at the same time. I was very curious to see kind of which one would come out on top versus the others. I mean, I definitely have my biases going in just based off of I guess my perspective of each of these companies as a consumer. But yeah, we'll definitely get into that. But anyway, so continuing with the discount rate. Without that, they have a levered beta of 2.44 is, that's a huge beta. And so adding that onto the already relatively high equity risk premium from the geographies in which they do business, that means we end up with a total risk premium over 17%. Adding that onto the risk-free rate, we end up with a cost of equity of 20.46%. So a really huge cost of equity, which again is not uncommon with financial institutions with the way that I do my calculations, like the way I do discount rates. That's pretty typical. Is to find financial institutions with pretty high costs of equity.
But obviously their valuation is coming out not terribly, regardless of that fact. So that's the other thing to counteract it. And then also the thing that's worth noting is that that's the cost of equity. So that's the cost specifically for the equity shareholders, which is only one half of the calculation for the cost of capital. We saw before that they had a really low interest rate, and since they obviously have a much larger amounts of debt than equity, that means when you actually weigh them all together, the cost of capital ends up being only 6.5%. So for the equity shareholders are expecting huge double digits in returns. 20% is what equity shareholders should be expecting at fair value for Citigroup, given the risks of the business. But the overall cost of capital for the business itself as an operation is only 6.5%, which makes it, much more in line with what you would hope. Like if a company had a 20% cost of capital, oh man, that's a huge problem for the operations of the business. But cost of equity, well, that just means that there's risks for the equity shareholders relative to the debt holders. So we'll get into the financial history of the business, talking about the financial history I have for them covering from 2012 to 2021. We can see that the revenues in 2012 went from 79 billion up to 82, 83 billion. So there is some upward movements. In fact, there was upward movements in the relatively short term and then downward movements. So it's been a little bit of an upward zigzag as far as revenues for Citigroup. Nothing too major as far as it goes. ORCA. Well, maybe take a look at that when I finish up with the valuation. Welcome to the stream. I don't think I've seen you in before, but thank you for the suggestion. Well, once I finish up with this summary, if you're still around, remind me if I don't remember, and we'll maybe take a look at it before I go. I don't even think I've heard of that one before. But anyway, so with that kind of just goes to show the overall relative maturity that Citigroup has had, and also some of the issues that they had with the organizational structure, which is part of the reason that they have their new CEO that they've had only for the last year, and the large new plans that they have for the reorganization of their business. They had kind of run into some stalling as far as their growth goes in the mid 20 aughts, being unable to find new expansions in more mature parts of the business. So they're looking to spin off some of the riskier and more foreign parts of their business and focus on the domestic parts of the business where they have a little bit of a regulatory edge, which makes a little bit more sense. Coming down into the net margins of their business, we can also see that the net margins have shifted a little bit over time. They've been a little bit more solidly in the double digits range in the last 5 years compared to the first 5 years, but not necessarily by too large of a margin. The average of the first 5 years of the business was about 15%, versus it averaging, well, actually, it still averages about 15% in the next 5 years because it includes this negative 8%. But if we kind of discount that particular year, which had some excess negative costs when they were divesting parts of their business, then it gets a little bit closer to 20%. If we take a look at the overall average over the long term, it still is pretty consistently about 15%, which goes to show with what I was saying before with typically if you're going to have a low sales to capital ratio, you'll probably have a generally higher net margin to kind of balance that out. So coming down to their cash flows, we can take a look at the cash flows that they had available to the equity shareholders, which is free cash flows adjusted for the debt issuance and also share issuance. For the first 5 years of the historic period we looked at, they had an average of about $5.8 billion per year they could have paid out to the shareholders. The amount that they did pay out to the shareholders was 4.7 billion. So they were paying out pretty significant amounts to their shareholders, but not an overpayment. In the next 5 years, it averaged 37 billion, which is a pretty dramatic shift over going from about 6 billion or so to 37 billion. So over 6xing in the cash flows that they could have paid out to the shareholders. That's not to say that like their free cash flows or something grew that large. I only draw attention to that fact to show that really they probably had some really negative cash flows in this year that were being balanced out by positive cash flows in the future years ahead. Not to mention the free cash flows to equity when it comes to a financial institution are going to be adjusted for the deposits being done in the business. So you can definitely see some very strange movements in in balances as far as the positives and negatives in free cash flows to equity for financial institutions. If we take a look at, for example, over the entire 10-year period, it averaged about 21 billion or so. And if we, for example, come up the line and compare that to their net incomes, you would find that the average net income was 12.5 billion. So you would still see that on net, there was significantly larger free cash flows to equity than there were net incomes. And then you would also have to adjust that for the fact that they're issuing debt. And in fact, on average, they're issuing much more debt than they were otherwise. But again, that includes the deposits in the particular debt issuance line for this, because cash flows to the equity shareholders is going to be post deposits for a financial institution. Anyway, I kind of digress from the payouts. For the, as I was saying, 37 to 38 billion on average for the most recent 5 years. The amounts that they did pay out ended up being about 16 to 17 billion, so definitely not massively overpaying. Sandfire earnings were decent. Listening to the earnings call tomorrow. Looking forward to your take. Are you planning on doing that after the banking sector comparison? Yes, absolutely. I've already gotten started on it. I read through the annual report yesterday, and yeah, I myself am looking to listen to that call probably after the stream today. But yeah, that'll probably, like I said, I'm planning on doing Goldman Sachs after this one today, and then Sandfire will be the one after that probably. So yeah, I'm already got that one well underway. As I said, that was going to be high priority as soon as that one came out. And yeah, I agree, pretty decent. It's definitely an interesting changeover in their financials comparative to last year, because they've dramatically shifted their business structure, what with the acquisitions that they made this year, and then they took on significant amounts of debt. So the balance sheet of Sandfire has like dramatically shifted in 1 year's time. So it's pretty interesting to see like how that does or does not change the valuation. But yeah, we'll get into that in about a week's time or so. Yeah, so coming down to the returns on invested capital, which returns on invested capital is also a pretty interesting thing when it comes to financial institutions, because they typically have really large amounts of cash on hand, and also their book equity is also usually a pretty strange proportion relative to their overall balance sheet. And so as a result of that, the way that I like to calculate the equities and the book capital for both returns on invested capital and return on equity means that I often end up having a negative book equity as a result for financial institutions, and that sure is the case for Citigroup. In fact, if we come down here, you can see that they have pretty regular negative returns on equity throughout the 10-year period, particularly in the last 5 years. We have 2017 as well as 2020 and 2021 all having negative shareholders equity returns on equity years, even though they didn't necessarily have negative profits in those years to speak of. So that has to do with the equity. So as a result of that, what makes this fall down to my general rule of thumb, which is that I generally then don't rely on the actual reported returns on invested capital, and I kind of just take the most recent year of returns on invested capital and I cut it in half, on the assumption that in order for them to retain their book value, they're going to have to essentially put a large amount of capital into the capital base to replace essentially the missing book equity. And so as kind of an approximation, I just essentially assume they're going to double their capital base, which means cutting the returns on invested capital in half. So as an approximation, that means that over the last 10 years, I would guess that they're a real approximation of the returns on invested capital that they actually could have earned in a sustainable way would have been more like 6.5%. Which, I mean, you know, comparing that to the actual average that they have returns on invested capital, the actual average I have here is 9%. So really, it's a small amount of punishment. I mean, it's not necessarily too dramatic. Coming down to the balance sheet, you can see sort of what I'm talking about. The overall cash flows, or the total cash on hand, moving from 23 billion in 2012 up to 235 billion in 2021. So they have 235 billion dollars in cash on hand on their balance sheet, which is, you know, pretty insane amounts of cash, you know, enough to be several companies in and of itself. And the depending on how you want to think about their assets, because it's a financial institution. So another interesting thing about financial institutions is that they very often don't separate their assets out into current or non-current assets in super clear ways. Oftentimes you kind of have to make some judicious decisions as far as like what you personally are going to count as current or non-current assets. But either way, so just thinking about their total assets, they have 2.2, almost 2.3 trillion in total assets in 2021. And that's up from 1.8 trillion in 2012. So yeah, they have grown their assets over the entire 10-year period, though it actually went through a little bit of a lull period and then upward pretty significantly. And you can see that, as I was saying before, the amount of cash they had on hand for the first 5 years of their business, or first 5 years of the historic period, was only about 20 billion. So 20 billions versus the still kind of averaging about 1.7, 1.8 trillion, and the versus the most recent few years or so where they've averaged well over 100 billion, perhaps closer to even 200 billion, versus their assets of 1.8 to 2.2, 2.3 trillion. So on overall, basically their cash as a percentage of their overall balance sheet has massively improved over the last 10 years. What was that? HPQ posted after hours today, might be one for the list also. It's also been on the Magic Formula list for ages, has low multiples, and Berkshire bought 11% recently. Yeah, actually it's been on the list in the past. I myself also have been a shareholder of them. I bought them a little high, decided I bought them a little high, and then found a good time to exit when there was a good pop, and so I kind of exited on that one point. They do appear to be relatively still cheap. The HBQ definitely doesn't look like a terrible investment necessarily, but I'm not necessarily super fond of companies that have negative shareholders equity. I'm willing to make exceptions under certain circumstances, but I think HPQ has a little bit of a bill paying problem, and so that's kind of one of my issues with that one. Yeah, getting back to Citigroup in your follow-up question, why are they sitting on that much cash? Well, I mean, there's multiple ways to think about that. They also do have debts to speak of. I mean, they haven't increased their debt in the same way they increased their cash liabilities. As you can see right here, for the first 5 years of the historic period, they averaged over 200 billion in debt. In the next 5 years, they averaged over 200 billion in debt, about 250 billion. So an increase, but not necessarily an overly crazy increase in terms of proportion. And also you can see that their total liabilities have also increased from like 1.5, 1.6 trillion to around 2 trillion or so on average over the period. So in proportion terms, their cash has moved up as a proportion of their total assets and liabilities, while their debt has not. So you could look at this as them simply lowering the risk levels to their debt situation. I mean, obviously, as I was saying, with my the way I do segmentation and the discounting, I'm counting their overall debt against their equity in terms of market value of the debt versus market value of the equity as part of how I lever up my beta. So they end up rating as a much riskier company with a much higher discount rate, which lowers their valuation as a result of having a huge amount of debt on hand. And so you could argue that having the cash on hand gives them the optionality to lower that risk at any given time. I don't know if that's necessarily their mentality about it. It could also just have to do with the fact that they also are an investment bank. So having a large amounts of cash on hand opens them up to having lots of collateral available for all sorts of different derivative transactions or counter balance repurchase agreements or something. There's all sorts of things when it comes to financial institutions and investment banks that could make them want to have lots of cash on hand. It's hard to say specifically, and I don't think they've given overly specific reasons for it. But I mean, as I was kind of just implying, the idea that they have basically just as much cash on hand as they basically do in debt, not quite the same amount. They still have more debt than they do cash, but I mean, it gives them optionality. It's cash and equivalents, and our equivalents mostly government bonds. No, the equivalents in this case, because like it kind of depends on who you're talking to, what they count equivalents as, and so that's always a good question to ask. I'll say that for me, when I put cash and equivalents up here, it's basically just cash and various kind of alternate bank accounts. If it's going to be bonds, I'm going to put it in marketable securities. So it's not really government bonds. It's basically cash in other financial institutions that are counted as secure and not insolvable. So theoretically they can basically just pull that money out, but it might mean that there's like a slight delay on the money. But yeah, I mean, when it comes to government bonds, like some people might count like relatively short-term government treasuries as an equivalent. I'm generally trying to be relatively careful with that one personally. But yeah, so I mean, it is basically cash. I would consider this cash the value it is. I wouldn't say that there's any risk to the value of it per se, but like I said, it very well might be that they're just trying to have that on hand to counteract the various aspects of their business in terms of liabilities. Is there a way to figure out what kind of currencies they have? They do have some information as far as that goes in their 10K, which you certainly could go and dive into some of the specifics of it. I'm definitely not going to get into it here in the stream specifically. It's worth noting that financial institutions usually have really, really huge 10Ks. This one's 327 pages. So the reason why I point that out is because like they usually have extra pages as far as like detailing the specifics of the types of assets they have and the types of contracts they have and like what's in there, and also like the way in which they calculate the values of the assets for those things. With the dollar being so strong, it might be a risk. To a certain extent, I would agree, but part of the reason that I selected these banks is that I don't think that their international exposures are necessarily the worst to speak of. They also some financial institutions have, like I said, like Citigroup does have a significant amount of foreign business. Like obviously, I had already said that it's only actually about 40% that's in the United States. But then also about another 30% is in Asia and Latin America, which are relatively speaking, as far as like the movements in the strong dollar currently, these are the parts of the world that are not necessarily dealing with the brunt of that. It's definitely more Europe that's definitely dealing with the brunt of the strong dollar currently. So I would say that you could look at it as being balanced out depending on the geographies that they're in. I specifically was trying to avoid a bank that had too much overexposure in the Europe area, and so I kind of like Citigroup partially because it is balanced out a little bit more geographically. But yeah, I mean the strong dollar is going to be in effect one way or another. But I would also say that also increases the value of their American assets itself. And also, as had discussed in the guidance in their presentation and their overall business plans, they're working on divesting some more and more of the foreign parts of their business anyway. So I don't know, maybe if they time the sales of those assets, they might be able to get out of that exposure in the right time, but it's hard to say more specifically. So coming down to the sales to capital ratio, we can see that that's kind of well in line with what I was saying for their industry. Their industrial expectation being 0.27 for the most recent year. And you can see that over the entire 10-year time frame, they're averaged about 0.26, so pretty much perfectly in line with their business, which also goes to show back up to what I was showing as far as their margins. Their margins averaging about 15%. I had said that the industrial expectation that I have listed here is just the most recent year due to a lot of banks having really bad write-offs in the last year. So having a 15% or 10 to 15% margin, I think, is pretty relatively in line with the industry as well over a longer term time frame. And I think that that's reasonable to think of because they are in line with their industry as far as their sales capital ratio goes. So now getting into the projections for the business as a whole, I did build a revenue model for the business, kind of similar to what I had done for JP Morgan, which I kind of already showed a little bit of it when I did the JP Morgan valuation. In fact, I have the JP Morgan valuation open right here so I can show the difference between it, as well as Goldman Sachs. So I basically built a revenue model using the exact same methodology for all three of these. And what I did is I took the average of the average trading rate of the 10-year treasury by each of the years that we have for the historic period between 2013 up through 2021. We're using 2013, not 2012, because of another detail related to the assets on management that I was looking at that I decided not to go with that methodology. So I just end up with these years rather than 2012, but whatever, it's kind of irrelevant. But either way, so the average 10-year treasury for each of these particular years, and then seeing the growth of that 10-year treasury rate over the time frame. The logic being is that the higher rates are, the better banking institutions do, because they make money off of spreads of rates. So whenever treasury yields are at one rate in one year and they move up in another year, that means banks are able to capture on the movement up better than they are on the movements down. It's not so much about where the yield is, it's about the movement up in the yield that gives them the ability to profit off it in the first place. So by having the year-over-year change in the yield and comparing that to the year-over-year change in the revenues, I found that for Citigroup, they are about 86 to 87% correlated. And if you take the R squared, you find out that it explains about 75% of the change in revenues. So that's very strong statistical correlation. So the theory matches and the empirical data matches. That's what we like to see. I did the same thing for JP Morgan. I found that they were about 74% correlated, so not quite as strong, and it explains about 54% of the change in JP Morgan's revenue. So not quite as strong for JP Morgan. I did the same thing for Goldman Sachs. 74% for Goldman Sachs, 54% explained for Goldman Sachs. So Goldman Sachs and JP Morgan kind of fall more in line with each other. Citigroup, this methodology actually works the strongest for. And Nukit, why did you choose to omit BOFA from the sector comparison? Partially, my selections of these companies isn't necessarily based off of overly specific investment things. It's kind of just some favoritism in the selection. So don't necessarily take it as some sort of like qualitative reasoning. I'm not planning to do an overview of BOFA. It's partially literally some very unrelated to invested things where some people were talking about certain qualities, certain banks, and certain details related to who runs them, and like these three names came up, and I was just thinking about it in relation to this channel. I was like, you know what? I'm just going to go ahead and value those companies. So don't necessarily think about like this group in relation to, for example, the other competitors that I listed, that being like Wells Fargo, Bank of America, or Morgan Stanley, for example. Like, you know, it's possible if I had done like all 7 of those companies, we might be able to do a better comparison group. But I'm not going to do all 7. I'm just doing these 3. But anyway, kind of getting back into the model. So if we take a look at the like I said, the overall change over in the years, it's correlated 86 to 87% and explains about 75% of the change over revenues. The current year 10-year treasury is at 3.1% or so. And so I'm creating a pretty wide band of assumptions saying that in 2026, I think rates could have moved upward towards 7% or downward towards 1%. Now, again, this isn't so much about where the yield is, it's about the upward movement to that yield or the downward movement to that yield, and the effect that has on the revenues when it does that. So when I'm looking at this, is like, don't necessarily think of it as like, oh, that's where the yields are necessarily going to be, though it very well might be that's where it's going to be, but that's not really the point of this. The point is more about the relative gain that they get on the movement in the yield itself. But either way, you can still think of it as sort of being like the yields are going to be there in that year. But in 2026, 7% to 1% on a basis. Average between the two is 4%. We're currently at 3%. We're expected to move up to 4% within the next year. So I'm essentially just assuming that I think rates are going to stay in that range, or at least move upward into that range over a longer time frame. But either way, so using a linear correlation through the spreadsheet right here, and the assumption that it's going to move up toward to 7% or downward to 1%, I end up with a best case scenario revenues of 121.7 billion in 2026 and a worst case scenario of 63.1 billion in 2026. Is that a historical proven fact? Is what a historical proven fact? You're going to be more specific. So coming over into the projections, that is what I have right here. The worst case scenario, I have it set to 63.4, so it's roughly in line with what I had set for that, and the best case 123.6. To kind of get into what you're saying, are you saying that when yields rise, the rate changes result in profits? Yes, that's basically a fact. It's going to depend on the bank and depend on like how specifically they're doing their business. But yes, how banks make money is they borrow money from one set of people at one rate, and then they charge a profit rate against somebody else, and they call this a spread, right? So they borrow money at 2%, they loan it out at 5%, they pocket the 3% difference. So if you borrow money at 2%, and then over the course of the next year, the rates move upward towards where you should have been borrowing it at 4%, say, that means that now the rate you can charge on the person you're loaning the money to has increased as well. So that means that you already made your loan, and now you get to charge higher profits on the rate of it. So yeah, banks make typically, traditionally, there are lots of exceptions to this. Like I said, it can depend on lots of other things, and this is specifically just talking about borrowing money and loaning it out to other people. So if you're managing assets and you're charging fees based off of like the performance of assets, well, that's going to do different stuff. But traditional banking, this is how banking works. That only happens when people take out new loans with rates being higher. Well, yes, but the way banks operate is that they're going to manage the duration of the loans. See, like your statement that only happens when people take out rates being higher, that assumes that the duration of the loans are going to be the same. What banks typically do is they borrow money for 20 years and they loan it out for 3 to 5 years, which means they get to control when the maturities of the profits come true, and they also get to then roll over the rate changes, which is why if the interest rates go down during the time frame, then they're gonna be in more trouble, because that means that now they have to roll over their loans more times. Yeah, like I said, there's lots of exceptions. This is kind of like a general rule of thumb because it depends on like lots of the details of how they're operating their businesses, and different banks are taking like other sides of the transaction against other banks and doing so it's very, very complicated. But traditionally, how banks work is that in rising rate environments, they do better. in lowering rate environments, they do worse. And like I said, it's not about the rate being high or being low. It's about the movement upward or downward, generally speaking. And I mean, like I said, you can see this in some of the banking revenues and profits over the last 10 to 15 years as well. It's like banks that have been much more consumer focused and much more like traditional consumer or commercial banks have had a lot more difficulty growing the revenues and their profits over the last 10 to 15 years versus other banks that have segued more into other aspects of investment banking and asset management. That's definitely like something that has been seen in the trend over the time frame. And like I said, it would depend on the bank, but either way, it's the methodology I'm using for this. So my worst case scenario revenue is 63.1, best case scenario is 121.7, and I use -2% and 12% to kind of get approximately to that point here. I'm also using the 2-year average of the most recent year revenues and then multiplying that by 0.9 to kind of get a simulated decline in the next most recent year or two in revenues. It's worth noting that the analysts are projecting this year revenues to be 75 billion, so that actually would be relatively up once you adjust for the divestitures, and then they're also expecting 76 for next year, and like, again, that would be down from 82, 83 if you don't adjust for the divestitures. So that kind of goes in line with what I had been saying when I was looking at the presentation, which is that they were saying low single-digit growth, but that's not accounting for the fact that they're spinning off certain parts of their business. So on an expected basis, I get about 74 billion for this year, 2022, and then I'm seeing 77, 78 billion for 2023. So a little bit low for 2022 compared to the analyst expectations, and a little bit higher than the analyst expectations for 2023. So I think it kind of balances out to be roughly in line with the analyst expectations. What are the divestitures? They're spinning off large sections of their foreign operations, the legacy franchises. They reorganize large portions of their business into new segments. One new segment that they have is called the legacy franchises, which includes Asia consumer, Mexico consumer, small business, and middle market banking, and a few other legacy holdings. And then they're working on finding sales for those assets at the right times in the right places. And then like through the last 2 quarters, they've actually done a decent handful of said sales. So yeah, which is why, like I said, there is a little bit of an expected decline, even though their guidance kind of implies that there's growth. So it's kind of like I have to read between the lines in their presentation to find sort of the truth on that. So as I had said, their kind of longer term average of their over the last 10 years has been closer to 15%. As far as their margins, I am leaving the margins kind of in place and alone for the short term, considering I am punishing them a little bit as far as the revenues go in the short term. But I am actually going to give them a little bit of a small boost as far as the long term, allowing it to kind of move up towards the upper end of the teens due to the fact that they are doing these divestitures, that it should make them slightly more profitable over the long time. Sounds like a lot can go wrong there. Oh yeah, absolutely. Absolutely. I mean, trying to sell off assets during a not super great economic time frame, that's definitely a concern. Something to keep in mind that whenever any company is trying to do these divest certain parts of their business, they might end up taking larger impairment costs due to spinning off those things possibly. So yeah, that could also affect their profitability over the long term. And I mean, like I said, I'm assuming a little bit more generous of a profitability over the long term. You could argue that it could be hit a little bit like that. That's like one way that this valuation could be shifted a little bit. I guess I'm feeling a little bit more confident about it just because of the profitability that they've already had in the last couple of years, as they've already started this process. They've already kind of shown a little bit of a better profitability over the beginnings of this process. That kind of makes me feel a little bit more confident in their ability to continue it. But it is worth noting that that was in a slightly peachier times comparative to like this next year or so that it might possibly be. So yeah, that's definitely something to keep in mind. So coming down also to the sales capital ratio, to keep in mind like how they will be funding the assets of their business. As we had said before, the sales capital ratio is averaging about 0.26, so I'm going to allow it to be on a pretty wide range between 0.1 and 0.4, which gives us a midpoint of 0.25, and then I'll have it lean towards 0.3. It gets us an expected ratio of 0.31, which is down from the 0.34 that they had in the most recent year. So we're kind of assuming that they're going to be moving a little bit more towards their longer term average, but they'll still be relatively close to where they are essentially in the most recent year or so. So with all of these assumptions in place, that kind of gets us to our final valuation, after also having adjusted for the default risks, which, as I had said with the JP Morgan valuation, financial institutions generally also have a pretty larger amount of default risk comparative to other valuations I do. Usually I'm a little bit more critical of companies once they get over the 1% per year default risk line. But for financial institutions, it's kind of something that I'm a little bit more willing to kind of ignore the actual value of the default risk and just think about like how did it affect the fair value. So as long as the fair value comes out to be generally okay, I'm willing to accept it as is and not really specifically not choose a company specifically for that reason. Whereas like other valuations, I'll specifically not invest in them just because they have a substantial default risk. So yeah, this gets us to roughly our final valuation. Though, like I said, you could definitely quibble about some of the details, like the margins that I gave them. You could argue that maybe it could be a little bit lower as far as that goes, because they're going to get bailed out anyway. Well, I mean, that's definitely an argument to be had about owning any of these large financial institutions, certainly. But I myself definitely don't look at being too big to fail as like a bonus for the equity shareholders. In fact, I would say that that's part of the reason their discount rate is so high. I'd say that financial institutions have had really high discount rates in the last 10 years, 10 to 15 years, since the financial crisis, partially because a lot of people just don't want to own them. A lot of people just don't want to own banks because they don't trust them. They look at them as very big, complicated machines. I mean, as I had pointed out, it's like 327 pages for a 10K. Aswath Damodaran has often joked that if you wanted to, you could probably make a much more simpler process as far as like coming up with the riskiness of a company, tossing out all the like complicated qualitative and quantitative metrics that people use for coming up with risk metrics. You could instead just like build a risk metric simply off of the amount of pages in the 10K. It's like his argument basically being that like if you need 327 pages to tell me what you did in 1 year of your business, then either A, your business is way too complicated, or B, you're trying to hide something. And I mean, look at banks. Banks are always basically the top of that list. Like I've looked at a lot of 10Ks. Banks and other financial institutions are always the top of that list. So yeah, I think there's a direct correlation between this huge ass discount rate that I'm giving them and just the sheer complexity of being in a financial institution, and the complexity partially comes from being so highly regulated. That's part of the reason I brought that up in relation to that. It's like they have to go through so many layers of having all the various capital ratios, making sure they're in compliance with all the regulation operations, that it just makes so much risk to the business. And after the financial crisis, a lot of investors decided that they're like, you know what, I'd rather just not even bother. And as a result, they've all been priced super cheaply ever since. So anyway, I digress. We'll get into the actual kind of summary. 10-year treasury selling for 3.1%. Oh, actually, before I get into that, I will say if you are watching up to this point and you haven't already, please give the stream a like. If you're watching and you haven't subscribed to the channel, please subscribe to the channel. Subscribing to the channel will make sure that you can get a notification whenever we go live, and liking the stream will help make sure that we can get more viewers for the channel. So go ahead and do that. And also, if you haven't joined the Discord, the link is in the pinned comment and also in the description below. Join the Discord. You can join our little community we have there, where we share daily news in the markets, as well as have discussions about what's going on in the market and details about our portfolios, and as well as analysis of companies that we're looking at. So join the discussion in there below. So taking a look at the summary for Citigroup, ticker C, U.S. Treasury selling for 3.11% or so. Mature market equity risk premium that I currently have is 5.56%. That equity risk premium has just been climbing and climbing, little bit by bit, week by week, as the S&P earnings has started to adjust. But anyway, getting off of that, the discount rate for Citigroup after adjusting for company-specific risks, as I was just talking about, which the primary large amounts of risk that they come from is partially from the areas that they operate their business in. They do have a significant amount of foreign geographies that have higher risk premiums, as well as their huge amounts of debt relative to their equity value, which again is not uncommon for financial institutions, but it does typically end up with relatively high discount rates. It's also worth noting, since I am kind of comparing these to the other financial companies that I valued, JP Morgan did not have that high of a discount rate. They had a much better discount rate. What was it, 12%? But even so, my fair value for them is not coming out as great. So you can have a much lower discount rate and still be even more overvalued. It's kind of, I guess, the point to be had there, or maybe that just shows the confidence that a lot of people have in JP Morgan, that they're willing to bid that price up higher and higher and higher. But anyways, getting distracted even more. The current dividend yield for Citigroup, based off of their trailing dividend, which is not expected to grow, is at 4.16% currently. Their sales 5 years ago was 76.5 billion, and the most recent year is 82.9 billion, which equates to sales growth of 1 to 2% per year on a compounded basis. So really, really slow sales growth. If you extend that out over a 10-year period, it becomes even less sales growth, which is kind of in line with sort of what I was saying before. It's like low yield, or even declining yield environments makes it very hard for banking institutions to grow, especially if they're much more focused on the more traditional banking aspects. Sales capital ratio has been 0.26 over a longer 9-year rolling period, which is well in line with the sales capital ratios expectations that we have for the business in the most recent year of 0.27. Their returns on invested capital, we have a little bit of an adjusted metric for approximating their historic returns on invested capital, which I came up with just over 6%, which is off of the back of, like I said, a really large debt to equity ratio. This is market values of their debt to equity, comes out to be about 286% as I calculate it, which equated in the most recent year of relatively negligible default risk due to relatively high cash flows in the most recent year comparative to more standard years. And the profit margins over the longer term average for them has been about 15%. Again, and their industrial average, due to large amounts of write-offs in the last year, had basically no profit margin, or relatively slightly negative. Profit margins for Citigroup in the most recent year was 22 billion or so, and they're currently selling for $49.08 per share. The probability distribution that I'm using for my future projections is our pretty standard, pretty normal distribution, with most of the weight weighted into our median case third model. And I have revenue expectations of anywhere from 63.4 billion in the worst case scenario to possibly 123.6 billion in the best case scenario. On an expected basis, I see 91.6 billion, which is sales growth of anywhere from -5% per year to possibly a little over 8% per year. On an expected basis, we see about 2% per year. That gets us a sales to capital expectation of 0.31, and returns on invested capital after applying all the other assumptions we see across all of the models, about 5.88%, which is a little bit lower than the returns on invested capital approximation that we had made. And it's worth noting that this is not based off of the same type of approximation method. So the fact that I end up with a number that's close to that means I think that approximation method is actually a pretty decent rule of thumb to use when all else fails, which is what I do when all else fails. And also, I'd also comment that we had been comparing the discount rate, which is over 20%, to their actual weighted average cost of capital, once you take into account the fact that the debt part of their capital is actually extraordinarily cheap for them. And so the actual weighted average cost of capital ends up being 6.5%, which is a much more respectable, much less dramatic sounding cost of capital, and is much more in line with lots of other companies' cost of capitals, for example. However, as we were showing right here, the returns on invested capital that we're projecting for them for the next 5 years is, however, still lower than that 6.5%. So unfortunately, they won't be earning excess returns if my assumptions are correct. We do have a debt to equity assumption on an expected basis. I'm seeing about 332%. So I'm assuming it goes a little bit higher than it currently is. And that's probably more off of the back of the market cap declining than anything, but who knows, maybe they could issue a little bit more debt. It's partially just me being a little bit conservative to kind of generally assume that the debt to equity ratio will likely move up a little bit. But that does give them a pretty substantial amount of default risk across the various models. On an expected basis, as I said, it ends up being about 3%, which that's a compounding figure. So over the 5-year period, that means we would expect about 15% chance of issues with their credit and their defaults over the time frame. And that, I would say, that's the much more representative part of what I would say the too big to fail, is the fact that, like I said, you see financial institutions with all of this like pretty substantial default risk, and they just kind of ride with it. As I said, the equity values themselves are actually pretty well adjusted for that fact. So much so that essentially the equity investors are kind of like, yeah, okay, that's just part of the business. And even, I guess you could say, even that was my own reaction. Even I had started this conversation by saying, well, when it comes to financial institutions, you can kind of not really think about default risk in the same way, as long as the value is fair. So essentially, the markets agree with that opinion, is kind of what I'm sort of saying. It's like you wouldn't see this normally this type of default risk on a company and find it trading at fair value. So typically, for most companies, usually it would have a much crazier dynamic going on with it, so to speak. But you could argue that the fact that banks do this in the first place is the fact that they know that there is governing institutions out there that will probably bail them out when push comes to shove. But anyway, getting distracted from the point. Profit margin, I have a distribution of 5% to 30%. On expected basis, I see about 18 to 19%. This is the part of the valuation that, like I said, is maybe the part where you can say I'm being a little bit generous to them. As I said, I actually feel somewhat confident in their ability to do what they've been doing for the last year or so, which is spinning off a few more parts of their business that are less profitable. I do think that they might not get a good price for those assets, as we were discussing a little bit earlier, but I think that the actual end results on the operations of their business might be pretty good for them, if for no other reason than it will likely lower the discount rate by changing the geographies in which they operate their business. So even if maybe that's not actually going to show up in the profit margin parts of the business, it very well might show up in an increase in their value somewhere. So you could say that that's maybe me just shifting where that effect is going to have its hold. But anyway, I end up with a profit expectation 5 years from now for the company of about 17.1 billion on an expected basis. And using the discount rates that we have across all the various models, that gets me an expected present value price of $45.01 per share, which is 8 to 8.5% lower than the current share price. We have 5-year forward value targets unadjusted for the dividends that they'll pay out during the time frame of anywhere from $35.71 per share to possibly $303.92 per share. On an expected basis, I would see $114.17 per share, which compared to the current share price is a pretty great return. That's an expected 18.39% per year for the next 5 years. So yeah, there's pretty high expected returns to be had for Citigroup, but what I would say is that they're not very well risk adjusted returns. There, because the fair value is in fact 45%. Because given the risks of this company, given the massive debt to equity ratio and the huge default risks that come with that, and given the not great returns on invested capital that also comes with that, and also given the not really great growth to the business model inherent within, all those factors taken into account means that you really ought to be getting that fair value at a minimum, which is kind of the point of fair value, right? So yeah, the idea that even at fair value you should be demanding 20% returns, well, for this type of institution, maybe that makes sense. Yeah, meh. That sums it up, I think. Meh. Which is true of most financial institutions. It's like you should definitely take a skeptical eye when it comes to these large behemoths with their super complicated business structures that makes it very hard for you to see inside and to really be certain of what's going on in there. You kind of have to punish those companies with higher discount rates. It's kind of how it works out. So yeah, happy to have added it to the list. And like I had kind of pointed out, is like it's very interesting to see how it compares to something like JPM. It's like in one sense you could say it's better because it's closer to its fair value. It has higher expected returns, but JPM has a way less default risk, much less default risk. The JPM, I mean, their debt to equity ratio is over 100, but it's not like to the point where it looks abnormal, right? Like lots of companies have debt to equity ratios over 100. That's not like something where it makes it turns your gaze, versus say like a 300% debt to equity ratio. So there's definitely way less risk in JPM, but there's also much more standard kind of market typical returns to be had in JPM, is basically what it looks like to me. Kind of comparing the value score between the two, you can see that the value score that I come up with for a Citigroup is much higher than JPM, but the value score is much more based off of like the returns. So that kind of makes sense. It's not really a qualitative aspect. I would definitely say that JPM is the much higher quality company as far as how it's run, how it's managed, and all that. Citigroup is a business that was managed poorly for a long time and is only now starting to be run better, which is kind of the point. It's like you can maybe argue that Citigroup's more of like a banking turnaround, whereas JPM has been well managed for well over a decade. Pretty much ever since Jamie Dimon took the helm. Ever since Jamie Dimon took the helm, I mean, this baby's been very well managed. Whereas Citigroup, that new CEO, I think she's doing a pretty great job, but she's only been at the helm for about a year or so. So maybe in 10 years time we'll be looking at a similar quality business. So if you're looking for really high returns and really high risk, Citigroup. If you're looking for low returns, low risk, JP Morgan. We'll get into what we think about Goldman Sachs next in the next valuation. So that's gonna basically do it for the stream today. I will take a brief look at that one suggestion that we got. I don't know if our buddy over on Twitch is still watching or not, but he had suggested this one. Was it Orca? Uh-oh, it's already looking like something not super appealing. It's a coin? Oh, I didn't even know that. Yeah, I'm not super interested in coins myself, so I'm definitely gonna have to pass on that one. I thought it was a ticker, but yeah, he had dropped that one in there. But I don't know, maybe somebody's interested in the Orca coin. But yeah, so that'll do it for today then, I guess, if that's all that was. Yeah, get out of here with that. Not exactly the channel for that per se. I don't know. Maybe somebody at some point will give me a really good value proposition for a coin, but it would probably be difficult to convince. I mean, hey, that's not to say I've owned Bitcoin before, but I also sold Bitcoin once I became clear that we were going into a rising rate environment, because I knew that was an asset that only worked well for low rate environments. And I also bought Bitcoin at like 3,000, so it was a little bit different, but you have to have a good argument for that. I'm definitely not super interested in random coins. But anyway, so that's gonna do it for the stream today. As I was just saying, Goldman Sachs is the stream that we're planning next for Thursday, and then I'm also expecting to do Sandfire Resources, ticker SFRRF, probably the following Tuesday thereafter that. So thanks for watching the stream up to this point. If you are still watching at this point and you haven't already liked the stream and you're watching it on replay, please like the stream. Please subscribe to the channel. Please join the Discord. You can find the link in the description below. All right, I'll catch you all again next time.